There's a building at the corner of Wall Street and Broad Street in Manhattan that represents something impossible according to standard economic history. J.P. Morgan and Company headquarters. The financial institution that by 1913 controlled more wealth than the entire United States Treasury. That had representatives on the boards of 112 corporations worth over $22 billion. That could trigger financial panics or end them with a single decision. This level of power didn't develop over centuries. It happened in less than 60 years. Before 1854, the Morgan family had no presence in American banking whatsoever. None. Then within 2 generations, they controlled the entire financial system. The question isn't whether this happened. The question is how it happened so fast and what mechanisms allowed a complete unknown to become the most powerful financial entity in the country. Junius Spencer Morgan was a dry goods merchant in Hartford, Connecticut in the 1840s. Not a banker, not connected to banking families, he sold textiles. His son, John Pierpont Morgan, was born in 1837 to a family with no banking history or financial connections. This is documented. The Morgan family fortune began in textiles, not finance. Yet by 1860, Junius Morgan was a partner in a London banking house. By 1871, J.P. Morgan had established his own banking firm in New York. By 1900, that firm dominated American finance. 3 generations from textile merchants to controllers of the money supply. Most standard histories explain this as brilliant business acumen and fortunate timing. That explanation requires ignoring the structural mechanisms that made such rapid ascent possible. The key moment was 1854. Junius Morgan became a partner in George Peabody and Company, a London merchant banking house. This wasn't a promotion based on banking expertise. Morgan had none. This was a strategic placement. Peabody was American but operated in London, financing American business through British capital. The partnership gave Morgan access to something more valuable than money, access to the network of British financial institutions that controlled global capital flows. London, in the mid-1800s, was the centre of international finance. British banks financed railroads, factories, governments worldwide. Getting into this network meant getting access to unlimited capital and the intelligence about where that capital was flowing. The timing matters. 1854 was 2 years after the publication of Uncle Tom's Cabin, 3 years before the Dred Scott decision. The country was moving toward civil war. British financial interests had strong preferences about the war's outcome, not based on morality, based on economics. The industrial North needed British manufactured goods and investment. The agricultural South exported cotton to British textile mills. Whichever side won would determine trade relationships for decades. British banks positioned themselves to profit regardless of outcome. They needed American representatives who understood both regions and could facilitate financial relationships with whoever emerged victorious. Junius Morgan filled this role perfectly. American-born, northern-based, but with southern business connections through his textile work. When the Civil War began in 1861, Morgan's firm financed both sides through different mechanisms, not directly. That would be too obvious and politically impossible. Through complex arrangements where British capital flowed to American entities that then made loans to governments and businesses on both sides of the conflict. The Morgan firm took a percentage of every transaction regardless of which side benefited. The war generated enormous financial flows, military equipment purchases running into tens of millions of dollars, government bond sales to finance armies and supplies, currency speculation as both Union and Confederate money fluctuated. Everything created opportunities for intermediaries positioned between British capital sources and American needs. J.P. Morgan's first major deal exemplifies the pattern and the moral flexibility required. In 1861, he financed the purchase of defective rifles known as Hall carbines. The United States Army had condemned these rifles as dangerous to the soldiers who would use them. Morgan arranged financing for an intermediary to buy them from the government at $3.50 each, then sell them back to a different procurement office of the same government at $22 each. The rifles were still defective. The mechanism hadn't changed. Soldiers would still be injured or killed using weapons that the Army had already identified as faulty. But the transaction was technically legal because different parts of the government made the purchase and sale. Morgan made his percentage on the financing. When questioned later, he claimed no responsibility for the rifle quality. He'd simply arranged the financing. This wasn't unusual practice. It was standard procedure for financial intermediaries during the war. The irregularity was how quickly Morgan's firm grew from this and similar deals that exploited wartime chaos and bureaucratic disconnection. After the war, the pattern continued, but the scale increased dramatically. Railroads needed massive capital to expand westward across the continent. European investors wanted exposure to American growth opportunities, but didn't trust American financial institutions, which had a reputation for instability and fraud. They trusted London banks, which had centuries of established reliability. Morgan became the essential intermediary between these two worlds. His firm sold American railroad bonds to European investors, taking fees on both the initial sale and the ongoing management. Not just any railroads, specific railroads that Morgan's firm then influenced or controlled through board positions granted as part of debt agreements and protective covenants written into loan contracts. This created a system where Morgan decided which railroads got funding and at what terms, how they operated their routes, what rates they charged shippers, and when they merged with competitors to reduce competition and increase profitability. By the 1880s, Morgan had perfected this model into a science, control through debt rather than ownership. A railroad borrows millions from Morgan's firm to build new lines or acquire competitors. The debt agreements require Morgan representatives on the board of directors. Those representatives, serving Morgan's interests rather than the railroads, push for consolidation, merger, operational efficiency that often meant cutting safety spending and worker wages. This reduces competition industry-wide, increases shipping rates that customers have no choice but to pay, ensures the railroad generates enough profit to repay the debt with interest to Morgan's firm. Morgan's firm makes money on the initial loan fees, on the ongoing interest payments, and on the increased value of railroad securities they hold as the monopolistic practices increase profitability. The same pattern worked for steel companies, electricity utilities, manufacturing conglomerates, any industry requiring large capital investments that only Morgan's European banking connections could provide at the necessary scale. The mechanism that made this possible was the gold standard. American currency was tied to gold. The government held gold reserves to back the currency. But gold supply was limited and controlled by a small number of international banks, mostly in London. If those banks restricted gold flows to America, the currency supply contracted. If they increased gold flows, the currency expanded. Morgan's firm, with its London connections, influenced these flows. Not completely, not as sole controller, but as a major participant in the network that made collective decisions about gold movements. The Panic of 1893 demonstrated this power clearly. A financial crisis caused gold to flow out of the United States. The Treasury's gold reserve dropped below the level needed to maintain currency stability. The government couldn't stop the outflow through normal mechanisms. President Grover Cleveland had to arrange a private deal with J.P. Morgan and August Belmont, another banker with European connections. Morgan's syndicate sold the government $65 million in gold in exchange for bonds. This stopped the panic. It also demonstrated that private bankers had more ability to control gold flows than the United States government. This power only increased. The Panic of 1907 was even more dramatic. Stock market collapse, bank runs, business failures. No government institution existed to provide liquidity or stabilize the system. J.P. Morgan personally orchestrated the response. He gathered bankers in his library, decided which institutions would be saved and which would fail, organized the financing that ended the panic. He was 70 years old, acting as a central bank through private decisions made in his personal library. The government played no role except accepting Morgan's direction. The public response to 1907 created momentum for government control of the money supply. If private bankers could start and stop financial panics, maybe that power should be government function. This led to the Federal Reserve Act of 1913. Standard history presents this as the government taking control from private bankers. But examine who designed the system. The meetings that created the Federal Reserve structure happened at Jekyll Island, in Georgia in 1910. J.P. Morgan's representatives were there. The system they designed gave private banks ownership of Federal Reserve banks and influence over monetary policy. The government gained formal authority. Private banks maintained functional control through the Federal Reserve structure. J.P. Morgan died in 1913. The same year the Federal Reserve was created. His firm continued through J.P. Morgan Jr. and successive leaders. The Morgan name remained synonymous with financial power through the 20th century, but the mechanism established between 1854 and 1913 persisted. Control of the financial system through networks connecting private banks with government institutions. The ability to influence currency supply through gold flows and later through Federal Reserve policy. The pattern of profiting from position as intermediary between those who need capital and those who provide it. The standard explanation for the Morgan rise emphasizes individual brilliance. J.P. Morgan as financial genius, his ability to see opportunities others missed, his decisiveness during panics, his skill at organizing complex deals, all true. But individual skill doesn't explain the structural advantages that made those opportunities available. A brilliant textile merchant in Hartford couldn't have built a banking empire without the mechanisms that allowed rapid accumulation of financial control. Those mechanisms were already in place, created by the international gold standard system and the network of European banks that controlled it. The revisionist interpretation examines those mechanisms rather than focusing on individuals. The gold standard created opportunities for those with access to gold supplies to influence entire economies. The international banking network created information advantages. Knowing where capital was flowing before others knew meant buying assets before prices rose and selling before they fell. The lack of government financial regulation before 1913 meant private banks could engage in practices that would later be illegal. Self-dealing, insider trading, market manipulation, all standard practice. The Morgan family went from no banking history to controlling American finance because they entered the system at the right moment with the right connections. 1854, when American capital needs were growing faster than domestic capital supply. London connections when London controlled global capital. Willingness to finance both sides of conflicts. Ability to operate in the legal grey areas that weren't yet regulated. These structural factors mattered more than individual brilliance. Brilliant people without these advantages didn't build banking empires. Well-connected people with moderate abilities, if they had the right structural advantages, did. This pattern isn't unique to the Morgans. It appears throughout financial history. The Rothschilds went from minor money changers to European banking dynasty through similar mechanisms in the early 1800s. The Warburgs did the same in Germany. The pattern requires connection to international capital networks, operation during periods of rapid economic growth requiring outside capital, and willingness to exploit regulatory gaps before they close. The Morgans simply executed this pattern in America during the period when American industrial growth created maximum opportunity. Understanding this changes how we interpret financial history. The rise of banking dynasties wasn't about individual merit triumphing through free markets. It was about structural positions in networks that controlled capital flows. Those positions were limited. You couldn't create them through hard work or innovation alone. You needed placement in the existing network by those who already controlled it. Junius Morgan got that placement in 1854. Why he was chosen rather than someone else isn't fully documented. But once chosen, the structural advantages made the rest nearly inevitable. The legacy persists in modern financial systems worldwide today. The mechanisms that allowed the Morgan rise still exist in modified forms, adapted to contemporary regulations and oversight. International banks still influence currency flows through foreign exchange markets and cross-border capital movements. Financial networks still provide information advantages through early access to market-moving data and regulatory changes. The connection between private financial institutions and government monetary authorities, formalized through the Federal Reserve System, still allows private profit from public financial policy decisions. The names change with each generation. The specific practices evolve to avoid new regulations. But the fundamental pattern of control through strategic position in capital allocation networks remains constant. The Morgan story isn't just history. It's the template for how financial power accumulates and perpetuates across generations through structural advantages rather than market competition.